Hi, today we're going to talk about budget rumours, particularly regarding pensions. I mean, every year I get all sorts of things said to me. Is this going to happen in the budget? Are we going to see cuts here, there, and everywhere? And in all honesty, in most cases, changing pensions on budget day is very, very difficult. But I'm going to touch on a few things particularly. I'm going to talk about tax-free cash, really important one. Questions asked about that probably for the last 20 years, and that's the 20 years I've worked in pensions. So every year I've worked in pensions, I get asked. We're going to talk about the normal pension age. We know that's changing coming up in 2028, so we're just going to mention that briefly. We're going to talk about tax relief, of course, and the annual allowance and lifetime allowance. And then a couple of comments on death benefits, and of course, the triple lock on the state pension. So starting with tax-free cash, or pension commencement lump sum, as we're supposed to call it. Every year someone comes to me and says, are we going to get rid of the 25%? Every year I say, it's very unlikely. The reason I say it's very unlikely is because, yeah, we have seen changes to it in the past. It may not feel like we have, but we have seen changes, but they've been related to the other allowances. So when we saw in 2006 the changes to the whole regime and brought in pension simplification, those people with tax-free cash in excess of 25% were entitled to protect that under certain circumstances. So there was a protection in place. The same when we saw the lifetime allowance drop from 1.8 to 1.5, that had an impact on those people with benefits of that level. And again, an impact on their tax-free cash, because you can only have 25% of the lifetime allowance. So you do see these reductions, but in those cases, they put in a protection to protect the lifetime allowance for those people with benefits at that level. So again, no retrospective changes for benefits built up in the past. And I truly believe that's where we go with pensions. Everything that's ever been changed in pensions pretty much has had a protection put in place. So if we do see any changes in the budget, then I do believe strongly that they will put a protection in place so that you can protect benefits you've already accrued. They're not going to retrospectively change the benefits that you've accrued in the past. So they're not likely to just turn around and say, actually, everything you take out of your pension now is taxed. So that's where I stand on tax-free cash, but we will wait and see because, as I said, there could be other changes that could have knock-on effects to the amount that you could actually take, such as the lifetime allowance, for example. We are expecting the lifetime allowance to go up this year, although it's very, very minimal because it goes up by CPI, and CPI was only 0.5%. So we're only expecting a very small change. We will expect to see that figure confirmed on budget day because there's a few numbers flying around because it depends on exactly how they calculate it, how many decimal places to determine the figure that we're going to start working with from the 6th of April. But they could make other changes to that. If they really wanted to, then they could cut back on the lifetime allowance or they could scrap the increases. So all of those things could happen. But I think they're not going to make significant enough differences to the Exchequer for us to actually see those changes, for the effort it would be to put in protections to reduce if they were to reduce the lifetime allowance. So I'm not sure we're likely to see that. So what I'm expecting to see is the small increase that we've been expecting anyway. So that's the lifetime allowance. So what about the annual allowance? Well, the annual allowance is 40,000 as a standard. The MPAA is 4,000. And then we've got the tapered annual allowance somewhere between 4 and 40. So again, I don't think there's probably much scope for change there. Simplification would obviously be great, but it's not something that we would expect to come in on budget day. Again, it would probably be something that would either be consulted or would come in at the turn of the tax year, like the lifetime allowance changes usually come in at the turn of the tax year. That's not to say that you shouldn't be using up your allowances. So just because the tax year end is the 1st of April this year, very importantly, because we've got Easter in the way, so the last working day of the tax year is the 1st of April, don't leave it that late to calculate and utilise your annual allowance. So if you're looking at this for clients, then make sure that you're doing those calculations now. And even if you can get the contributions in before budget day, all the better. Every year we see a rush towards the end of the tax year to make contributions. So there's no need to wait. If you've got the information to do those calculations for your clients, then do those calculations and get those contributions paid as a just in case. We can never say never with changes to pensions tax relief. So always worth getting in contributions when you can be sure that you're putting in the right amount and utilising the right amount. So on that note, with the annual allowance, obviously we can carry forward from 3 years ago. So we've got this year's allowance and the previous 3 tax years. So come the turn of the tax year, we'll lose the oldest one. So that's what you need to be considering. What will I not be able to do next year with carry forward? What am I going to lose from the oldest tax year? Always something to consider if you're looking at funding pensions to the maximum. We've also got comments whether the death benefits will change. Everyone sees the death benefit regime in DC to be very generous. I think it is generous, but it's probably not as generous as you might think. Quite often the people with the larger funds live a bit longer, so their life expectancy is longer. And once you hit 75, your benefits are going to be taxed one way or another, either in your hands as you draw them or in your beneficiaries' hands if you were to die or when you do die and they start drawing the income. Funds that are taken on death before age 75 are obviously income tax free in most circumstances, but there's probably less people these days actually impacted by that. So it's a nice to have, a planning opportunity, but most people are likely to live beyond the age of 75 and therefore end up paying tax on their death benefit. So I don't think the government are giving up as much as it might look when you think about how the pension freedoms impacted the death benefit. So I'm not, again, expecting any changes on that side. So we do know that the normal minimum pension age is going up, and that's not going up until 2028. And just a reminder there that there's a consultation out at the moment on the protections surrounding that from when we're going up from 55 to 57. So do get a look at that if you're interested. It regards doing transfers and block transfers and how it's going to work for schemes who have a protected pension age of 50 or 55, for example. So definitely worth something to consider and factoring into your conversations with your clients that it will be going up. So a lot of personal pensions, it will go up because their scheme rules basically say the minimum pension age, and that's changing in legislation. So it will automatically change in a lot of personal pension schemes. It will be the occupational side of things that may see retaining an earlier pension age of 55 or 50 or even younger in some circumstances, as we already have with the protected pension age regime. I should also just mention the triple lock. The triple lock itself is not written in legislation, so there's always a chance that we don't see the triple lock going forward, but it seems unlikely. It was a manifesto promise. It was something that we are intending to see, but I think if we ever saw some massive increases in national average earnings, for example, then it may be something that the government might consider is unsustainable. If we see a big jump, say 15%, 20% next year or the year after, then the triple lock would kick in as an increase of that amount on your state pensions, which will have to be paid every year going forward. It's not like it sinks back down because because of the triple lock, it's going to be 2.5% or NAE or CPI. So it's really important that those sort of things are considered. So it's not a guarantee that we're going to see it changing. It's not a guarantee we're going to see it staying, but it is something to always consider once we see earnings start rising again. If it's going to be an extreme number, then it might be something that the government considers, but it's unlikely to be something that I think we'll see in the budget. And in all honesty, there's not a lot you can do about it. So it's not something to worry about too much. So I think what people should be focusing on at the moment is planning for tax year end, but maybe treating tax year end as the 3rd of March. So if you can make decisions and you can make contributions based on the current legislation now, rather than wait until the end of the tax year, then all the better. And if you can't, then there's very little you can do about it. And I think, in all honesty, if we do see any major changes, what we're going to see are consultation papers. So that's what I just want to touch on. Tax relief itself. Quite often we see people talk about tax relief and tax relief changes, flat rate tax relief, for example, on pension contributions. They're all quite significant, very significant changes that would need to be brought in, and something that would need to be heavily consulted on, because it not only has an impact on the contributions that your clients are making, but will have impacts on contributions employers are making and the way in which they deal with any bonuses or salaries or any benefits in kind, for example. All of that could be impacted by any changes to the way tax relief is calculated for individuals. So I think it's a watch this space. I'm hoping, I'm fairly confident that we're going to have a quiet pensions day on the 3rd of March. But when the consultations come out later in March, then we might see a little bit more, or some little bit more thinking about possible changes, although not guaranteed changes. But we never know. So fingers crossed for a quiet 3rd of March. And I'm sure we'll be reporting back to you once we know what has actually happened. Thank you.